Hello and welcome to Chapter 4 in Tax 1. In this chapter we'll be taking a look at some of the adjustments for AGI. These are commonly referred to as above-the-line adjustments. They're very important because they help reduce AGI, which we all know is used to determine whether or not taxpayers qualify for further below-the-line deductions as well as certain credits. So we'd like to get our AGI number as low as possible. These deductions that we're talking about in Chapter 4 will help us to do that. One of the more common deductions for AGI is qualified student loan interest. The deduction limit is $2,500 on this interest that relates to student loans, and the educational loan could be incurred by the taxpayer or the taxpayer's spouse or any dependent as long as it's used to pay for qualified education expenses. And qualified education expenses then are defined as those that relate to, for example, books, tuition fees, room and board, transportation, supplies, equipment, and any other expenses that relate to pursuing the education. The educational expenses have to be paid within a reasonable period of time after the loan date in order to qualify for the deduction of student loan interest. The expenses must be incurred while the student was at least a half-time student, and the student could have been incurring undergraduate or graduate level coursework to qualify for the student loan interest deduction. Deductible amount, there is a phase-out period for modified AGI or MAGI, and in 2019 the limit begins at $140,000 and ends at $170,000 for adjusted gross income for a married filing joint, and then the phase-out begins at $70,000 for a single return and phases out at $85,000. So then the calculation for the phase-out, if it applies to the taxpayers, is the preliminary deduction, the interest, times the fraction or the extent to which the taxpayer's modified AGI exceeds $140,000 for married filing joint. And then we would divide that by $30,000, and this $30,000 is the range, the difference between the $140,000 low end of the phase-out range and $170,000, the high end of the phase-out range for married filing joint. For single taxpayers, the range is only $15,000 because here the modified AGI begins to phase out the deductibility of student loan interest at $70,000 and then is completely phased out. That is, its deduction is completely eliminated once the single taxpayer reaches AGI that has been modified of $70,000. So the $15,000 and $30,000 just reflect the range of the phase-out. And they give you a worksheet, student loan worksheet, in the text, and kind of shows you the process of determining how much, if any, of the $2,500 deduction it would be qualified for an above-the-line deduction. And just a note, if your modified adjusted gross income is below $140,000 for a married filing joint, then there is no phase-out, and you will get the complete preliminary deduction up to the $2,500 limit. Another common above-the-line deduction for AGI is a health savings account. This health savings account is used for medical expenses of the spouse, dependents, or of the taxpayer. However, to be eligible, the taxpayer has to be self-employed or an employee or spouse of an employer with a high deductible health plan, and we'll define that shortly. So an employee of a company that has no health coverage and has purchased a high deductible policy on their own may qualify for this above-the-line deduction. A couple of stipulations here to qualify for this HSA. The individual must have no other health insurance coverage. So the taxpayer cannot have other health insurance coverage except for accidents, disability, dental, vision, long-term, and workers' comp. And just to reiterate the point, if the individual is married to someone who does have health insurance coverage through an employer, then this health savings account deduction would go away, because if they turn down the coverage by the spouse's employer, then they don't qualify for this health savings account deduction. So this high deductible health plan for these health savings accounts have some limits for 2019, these out-of-pocket limits. So the minimum deductible and annual out-of-pocket for individual coverage is $1,350, and the maximum deductible is $6,750. So certain kinds of plans then would qualify for the health savings account deduction. And by the way, for family coverage, the limits go up to a minimum deductible and annual out-of-pocket of $2,700, and then the maximum out-of-pocket jumps up to $13,500. So the family coverage is double what the individual coverage ranges are. Again, these are for the deductibles to qualify for the health savings account deduction. Taxpayers who contribute then to or withdraw from an HSA during the year, they have to file on Form 8889 attached to 1040. And again, this is a great benefit to taxpayers because it's a for AGI deduction, which means it reduces AGI, and that's what we want. Because as I said earlier, that AGI number is important for determining subsequent deductions as well as credits. And the distributions from a health savings account are tax-free as long as they're used to pay for qualified medical expenses. So if someone uses these funds for on any other purpose, then they would lose the deduction. Another common above-the-line deduction is for moving expenses, and this is a relatively new change. It used to apply to the population in general if they had to move in relation to a job change, for example. Now it's limited just to those serving in the military. So a service member would not have to include, for example, in their income any moving or storage services provided by the government, as long as the change is a permanent change of station. And I would add, too, that they would not include any amounts received for dislocation allowance, temporary lodging expense, move-in housing allowance, and temporary lodging allowance. So if the military provides and covers these costs, they don't need to report that as income. Again, this above-the-line adjustment for military moving expenses would include storage of goods or household goods within a 30-day period, and these days have to be consecutive. They cannot be broken up. And the items are moved from the former home. There is, for 2019, a mileage rate related to moving of 20 cents per mile. That is deductible as well for AGI. And then moving expensive persons other than the military service member, as long as they are a member of the taxpayer's household, then those expenses qualify. You have a question and connect related to this. And any pre-moving costs, however, would not qualify. Costs incurred while moving are deductible. Another deduction above the line for AGI is the ability to deduct half of self-employment tax, and self-employment tax generally relates to Social Security and Medicare. So self-employed individuals who pay self-employment FICA tax equal 15.3% of net earnings, and again this would include both Social Security of 6.2% times 2 employee and employer portion, and then 1.45% for Medicare, again for employee and employer. Adding all those together, the total tax is equal to 15.3. Half of this tax is deductible for AGI by a self-employed individual. Now it's interesting that the 15.3% of net earnings from self-employment is the limitation. So net earnings, these are business revenues minus business expenses. So it isn't the gross. We take the 15.3% calculation of, again, FICA, and of course that includes Social Security and Medicare, but we take that percentage against the gross earnings less our business-related expenses. And then we have to file Form SE on Form 1040 to kind of demonstrate the calculation of our self-employment tax deduction for AGI. I mentioned earlier it's limited to 1/2, and this is kind of a breakdown then of the deduction. I think that 7.65% is on each side for the employee, and the employer portion, as I said earlier, is 6.2% plus 1.45% for Social Security and Medicare, respectively. And this is a for AGI deduction, and we report that on Schedule 1 of Form 1040. If you're self-employed and you pay your own self-insurance costs, then it's likely the self-employed individual would be able to take 100% deduction of their health insurance payments. The taxpayers cannot take a deduction for the amount in excess of their net earnings, however. So, and there's a problem like this that I'll demonstrate in Connect, right? If a person doesn't earn enough to cover their deducted self-employment costs, then the amount deductible would be the lesser of the two. In this case, it would be the earnings, the net earnings. And I'll demonstrate that in a Connect problem that you have shortly. A second limitation to the health insurance deduction for self-employed is that if the taxpayer is entitled to participate in any subsidized health plan maintained by an employer, for example, as I said earlier, the spouse of a taxpayer, the deduction is no longer allowed. This determination of whether or not there is alternative coverage is, however, made on a monthly basis. So we could prorate this for the year based on the portion of the year we had alternative coverage versus the portion of the year that we did not have alternative coverage. If you incurred a penalty on early withdrawal of savings, let's say you opened a CD 90 days and you decided you needed the money before 90 days and you withdrew it, and then the bank assesses a fee for early withdrawal of a CD, that penalty is a deduction for AGI on line 17 of Schedule 1 on 1040. And you would see this penalty reported on your 1099-INT that you'd receive from the financial institution. Another deduction for AGI above the line is alimony or maintenance. So there are three types of payments that relate to divorce or legal separation: alimony or maintenance, child support, and property settlement. Only alimony has a tax consequence. So if a former spouse pays alimony to a previous spouse, then the person, that taxpayer who pays the alimony, may deduct it for AGI above the line. And then the recipient of the alimony or maintenance would have to report it as income. There, of course, is no deduction or reporting of income for child support or property settlements. So no tax consequences for those two. Alimony is a legal consequence of you're required to make payments to the former spouse. And in order to qualify as alimony, it has to be a cash payment and must be under the requirements or provisions of a separation or divorce maintenance agreement. All payments must end at the payee spouse's death. So the payment of former spousal alimony does not survive the recipient's death. By the way, absent any of these provisions, then the alimony would not be deductible. This is an interesting caveat to this alimony issue. The recipient of the payments must include these payments as income, as we said, on their income. But if the alimony payments suddenly decrease in the second or third year of payment, the payments may be subject to recapture. That is to say, the formerly deductible alimony payments may all of a sudden be no longer deductible. And the reason that this comes up is that some taxpayers may attempt to disguise alimony payments in the property settlement, which is not taxable. And so if after the second or third year the payments suddenly drop, it's going to look a little bit like the alimony payments were included as part of the settlement. That is to say, they were rolled into the settlement so that they would escape taxation. So in the event these former spouses attempt to evade taxes this way, then they would lose. For example, the payer of the alimony would lose the deduction, and they would be subsequently taxed on that alimony. Another deduction for AGI is educator expenses. Educator expenses, for example, if you're a teacher and you pay out of your own pocket costs to cover supplies for the classroom, then there's up to a $250 deduction for AGI. And this is doubled if both spouses are, for example, educators, and they incur costs of up to $250 each of their own. Qualified expenses then for this modest educator expense deduction for AGI would include the purchase of books, supplies, equipment, including computers and software, and any materials for the classroom. It's a pretty broad range of educator expenses qualify for this modest deduction. There are AGI deduction limitations for tuition and related expenses. So, for example, only tuition and related expenses qualify. Has to be paid direct to the individual's academic institution and have to relate to their course of study. Here, however, for the tuition deductions, it relates only to books, supplies, and equipment, and then only if they're required or as a condition of their enrollment. So when we talk about for AGI deductions for tuition, they're a little bit more restrictive than we were talking about for interest that was deductible for AGI. Another consideration that a taxpayer may make here for deduction for tuition and related expenses is possibly taking, for example, a lifetime learning credit, advantage of the credit, or of the American Opportunity Credit, that may actually provide a better benefit than the AGI deduction. You cannot take both. But in this case, since we'll get to credits in Chapter 9, but at least in this case, we're talking about a deduction for tuition and course-related books and supplies. So the full deduction for AGI is up to $4,000. Maximum taxpayer has AGI, so there's a phase-out of $130,000. Begins at $130,000 and phases out at $160,000 for married filing joint, and the maximum deduction is $2,000 for a single person, and $4,000 that's doubled for married filing joint. But again, it does phase out within the ranges of $130,000 to $160,000 of modified AGI for married, and then $65,000 to $80,000 for single or unmarried taxpayers. If, however, the modified AGI exceeds these thresholds, then there is no deduction for tuition and related expenses. I'd like to take a look briefly then at some exercises that you have in Connect. Two in particular. Fabian, a single member of the military, was stationed at White Sands, New Mexico on July 1, 2019. His Army company transferred him to Florida as a permanent duty station change, which is required. Fabian worked full-time for the entire year. During 2019, he incurred and paid the following expenses. And so I have a little hint here. Only consider the moving expenses that were incurred during the move. So you'll be given really 3 sets of moving related expenses, but just kind of focus in on those that relate or were incurred during the move. Another problem in Connect relates to health insurance coverage deduction. Here, Shauna is self-employed, had net earnings of $3,500 from her self-employment business. However, she paid $325 per month for health insurance over the year. Shauna is entitled to a 4 AGI deduction for the health insurance premiums that she paid. However, this deduction for AGI cannot exceed the self-employment income. So you would take the $325 times 12, the amount she paid for health insurance coverage, and then compare that to her net earnings from self-employment. And then she could deduct the lesser of the two. So just a couple of insights on two of the problems in Connect. If you have any questions on these or any of the problems or concepts covered in Chapter 4, please let me know.